Hello viewers, welcome to my channel. I'm Hasham. So now I'm going to start the next problem number 14. Already 13 problems I've completed till the last video. So all these problems are dependent on the formulae. So if you are perfect on formulae, then only you can follow this video. Otherwise it will be very difficult. And in this video, I'm going to apply the new formulas which we have not applied in the previous problems. So every problem you will find a new method, new formula will be there. So you will learn a lot by watching each and every video. So don't join in between. So watch the video from first video onwards. Then only if you keep a rhythm 1, 2, 3, 4 like that, definitely you will get the full command. Otherwise, if you join in between, if you leave in between, if you watch casually, this chapter will not at all be easy for you. I told you many times that this ratio analysis is a very important topic for financial statement analysis. It's a technique of financial statement analysis which is applied in many organizations to take a number of decisions, financial decisions. So these ratios will disclose a number of facts regarding the liquidity, profitability, capital structure, solvency, activity. All these things will be disclosed by calculating the ratios. So it's very important. So my suggestion, if you have not watched the earlier videos, I suggest you to go to the playlist of my channel, select the subject financial statement analysis, select the topic ratio analysis, watch the initial videos, you will get the complete command. Then you come to this video. Definitely you will gain a lot of knowledge from these videos. So now I'm going to start the next problem number 14. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So go to the description, take a printout and keep it ready before start watching the problems. Now 14th problem. The balance sheet and income statement of Neha Limited as of 31st March 2017 is as follows. The balance sheet of the company is given share capital 2000, reserves and surplus not there. Non-current liabilities, that is long-term debt, we have 2000. Then current liabilities, trade payable 1400, accrued expenses 600. Accrued means outstanding expenses are 600. Total of the balance sheet 8000. Now asset side, fixed assets 4500. Then current assets, we have inventory, receivable, cash and cash equivalent. This is the balance sheet given. Now statement of profit and loss is also given for the year. Revenue from operations 8000. Then expenses are cost of revenue from operation 3300, finance cost 367, other expenses 3000. So total expense are 6667. Then profit before tax 1333, income tax 533. Then net profit after tax 800. So we are given the profit and loss statement, we are given the balance sheet. What it is asking, calculate the following ratios. Specifically few ratios are given and you are required to give the calculations. That's it. So one by one ratio, a number of ratios are given. One by one ratio we'll try to calculate. First one, current ratio. It's very easy to calculate current ratio. Current assets by current liabilities. So if you see the balance sheet, you can get current assets are 3500. The total of receivables, inventory, cash and cash equivalent, you'll get 3500. Current liabilities are only two, that is trade payable and accrued expenses. If you add up, you'll get 2000. So current ratio 3500 by 2000, 1.75:1. Very easily you have calculated the first ratio. Second ratio, debt to total assets. This is a different type of formula. Actually this formula, this ratio is not there in the list which I have given initially. I told you one of the limitation of ratio analysis is there is no limit to ratios. Unlimited ratios are there. So many a times a new ratio will come. So you have to derive the formula by seeing the wordings. Here the wordings are debt to equity, debt to total assets. So the formula will be debt divided by total assets because 2 is given. So debt divided by total assets. Debt, long-term debt is given in the balance sheet 2000 and total of the assets are given in the balance sheet 8000. So 0.5. 2000 divided by 8000, it is 2 divided by 8, it is equal to 0.25, not 0.5, it is 0.25. Debt is 2000. Yes, long-term debt 2000 and total assets are 8000. So 2000 by 8000, it is 0.25. That's all. Now I am coming to the next. Times interest earned. See carefully. Times interest earned. It is nothing but interest coverage ratio. In the previous problems also we have applied the formula for interest coverage ratio. PBIT divided by fixed interest charges. PBIT divided by fixed interest charges. So how to find out PBIT? PAT plus tax plus interest. Interest means finance cost. Finance cost or interest means same. So PAT, profit after tax, is given in the last line, 800 rupees, and tax, provision for tax 533 is given in the income statement, and interest are the finance cost. Add up the three, you get 1700 as the PBIT, profit before interest and tax. Now times interest earned or interest coverage ratio. PBIT is 1700 divided by fixed interest charges. Fixed interest charges are the finance cost. How much finance cost? 367. So 4.63 times. This is the interest coverage ratio. That means PBIT is 4.63 times of interest charges. Next one, average collection period. It is also known as debt collection period. So the formula for average collection period is number of days in a year divided by debtors turnover ratio. Number of days in a year divided by debtors turnover ratio. So before calculating average collection period, you must calculate debtors turnover ratio. So what is the formula for debtors turnover ratio? Net credit sales divided by average debtors. Due to lack of information, we are not given the information regarding cash sale, credit sale. Only sales are given. Sales are nothing but revenue from operations. Sales or revenue from operations are same. So it is given revenue from operations, sales by closing debtors. So we'll take sales. Average debtors we cannot calculate because opening debtors are not there. So we'll take closing debtors. Closing debtors. So sales means revenue from operations, that is 8000. And closing debtors, debtors means receivables. Debtors means receivables. It is given in the balance sheet, receivables 2000. So 4 times. What is this 4 times? Debtors turnover ratio. Now easily we can find out the average collection period, number of days in a year divided by debtors turnover ratio. So 365 days in a year divided by 4, you will get 91.25 days. This is the average collection period. What does it mean? That means the business is allowing a credit period of 91.25 days, approximately 3 months. That means the business is giving 3 months time period to the customers for making the payment. The credit period is 3 months approximately. So exactly 91.25 days. That is the average collection period. Next ratio, it is asking you inventory turnover ratio. So stock turnover ratio. The formula is cost of revenue from operations divided by average inventory. Cost of revenue from operations or cost of goods sold means same. So cost of revenue from operation divided by average inventory, average stock. Average inventory, average stock. But due to lack of information, we can take the closing inventory. Average inventory we can calculate only when opening and closing both are given. So opening inventory is not given, so we cannot calculate average. So we will take closing inventory. So closing inventory is 1000. And cost of revenue from operation given in the problem 3300. So 3.3 times is the inventory turnover ratio. Next ratio, it is asking you fixed assets turnover ratio. This is an old ratio. Already we have applied in the previous problem. Fixed assets turnover. Turnover means sales. Turnover means sales. Formula is revenue from operations to fixed, divided by fixed assets. So revenue from operation divided by fixed assets. So revenue from operations 8000 and fixed assets are given 4500. So 1.78 times easily we have calculated. Now assets. Total assets turnover ratio. This is also an old formula, nothing new. Fixed assets turnover. Turnover means sales. Sales means revenue from operations. So revenue from operation divided by total assets. So revenue from operations 8000, total assets 8000 to 1 time. That's all. Next ratio is return on total assets. Return on total assets, this is one of the profitability ratios. Already we have applied in the previous problem. PAT divided by total assets into 100. Profit after tax divided by total assets into 100. PAT is given 800. Total assets 8,000 into 100, 10% over. Next ratio, return on common equity. Return on common equity, that is PAT minus preference dividend, but in our problem preference share capital is not at all given, so no preference dividend. So PAT divided by equity share capital into 100. So profit after tax 800, equity share capital 2000 into 100, 40%. That's all. Next one, operating profit margin. Operating profit margin, this is called operating profit ratio. It's a profitability ratio. The formula is operating profit divided by revenue from operation into 100. Operating profit divided by revenue from operation into 100. Operating profit is not given in the problem. We have to calculate operating profit. Actually, operating profit means gross profit minus operating expenses. Gross profit minus operating expenses. But we don't have gross profit right now. So how we to calculate operating profit? We'll take revenue from operations minus cost of revenue from operations minus other expenses. Don't deduct finance cost, because finance cost is a non-operating expense. Finance cost is a non-operating, should not deduct finance cost. So operating profit is equal to revenue from operation minus cost of revenue from operation minus other expense. So 8,000 minus 3,300 minus 3,000. 1,700 rupees is the operating profit. Now simply substitute operating profit margin is equal to operating profit 1,700 divided by revenue from operation 8,000 into 21.25. Operating profit margin 21.25%. That's all. So comparatively this 14th problem is very, very easy, because most of the formulas already we have applied in the previous problem and it's very simple, straightforward. But the next problem, 15th, is a little bit difficult, because a number of new formulas first time we are going to apply. So give more concentration on this 15th problem. From the following balance sheet of Sunil Limited, you are required to calculate capital gearing ratio, fixed asset ratio, debt service coverage ratio, absolute liquid ratio, and basic defensive interval ratio. The 5 ratios we have to calculate. The information given in the problem: balance sheet of Sunil Limited, share capital 3,20,000, reserves and surplus 60,000, 12% debentures 1 lakh, current liability 1,05,000. Fixed assets are given. Current assets we are given short-term investments, inventories, receivable, cash and cash equivalent. This is the complete balance sheet. Now accounts, notes to accounts. So note number 1. Note number 1 is share capital 3,20,000. How this 3,20,000 arrived at? Here it is given equity share capital 2 lakh and 9% preference share capital 1,20,000. 1,20,000. So 3,20,000 is the total share capital. Then second, reserves and surplus 60,000. How do we get 60,000? Here breakup is given. Opening balance in P&L account was 25,000 and profit earned during the year is 50,000. So total 75,000. Out of which some fictitious asset, preliminary expenses was there 15,000. Deduct 15,000, 60,000 is the balance. That 60,000 is the reserves and surplus. Notes. Now additional information is given. The debentures are redeemable. How much are the debentures? 1 lakh. 1 lakh rupees are the debentures. It is a redeemable debenture. That means the company will redemption of debentures. Will make redemption of debentures. Redemption means paying back. The company will pay back the amount of debentures, that 1 lakh rupees. In how many installments? 5 equal installments. So 1 lakh divided by 5, 20,000. So every year company will return back 20,000 rupees. In 5 years, complete 1 lakh rupees will be returned back, redeemed. Beginning from the current year. The daily cash requirement for operational purpose is 5,000. Daily cash requirement, this is required for basic defensive interval ratio. During the year, the company earned profit after tax 50,000. Already it is given in notes, profit during the year 50,000. Profit after tax 50,000. Tax rate applicable to the company is 50%. That means after paying income tax of 50,000, The profit after tax is 50,000 because 50% is the rate of tax. The company has earned 1 lakh rupees profit before tax. So out of 1 lakh rupees, 50,000 rupees tax paid and remaining 50,000 is the profit after tax. That is the information given. Now we have to calculate the ratios one by one, 5 ratios. First, capital gearing ratio. First time we are going to apply the formula for capital gearing ratio. In the previous problem we have not covered. Now capital gearing ratio. The ratio is funds bearing fixed interest and fixed dividend divided by equity shareholders fund. Funds bearing fixed interest and fixed dividend. So what are the funds on which there is fixed rate of interest and fixed rate of dividend? That means debentures. On debentures there is a fixed rate of interest. Any other loan, if any other long-term loan is there, then fixed rate of interest. And preference share capital, there is fixed rate of dividend. On preference share capital, fixed rate of dividend. So in numerator we will take debentures plus other long-term loans plus preference share capital divided by equity shareholders fund. Equity shareholders fund. Now what do you mean by equity shareholders fund? Equity share capital plus reserves and surplus minus fictitious assets. That is the equity shareholders fund. Now one by one. Debentures are given in the problem 1 lakh. Other long-term loans are not there. And preference share capital is given in the problem 1,20,000. 1,20,000. So debentures and preference share capital will be taken in the numerator. Denominator equity shareholders fund. So equity shareholders funds include equity share capital and reserves. So equity share capital 2 lakh rupees given in the problem and reserves and surplus is given 60,000 after deducting preliminary expenses. After deducting preliminary expenses, 60,000 is the balance. So 2,60,000. So 2,20,000 divided by 2,60,000, 0.846. This is the capital gearing ratio. So remember this new ratio first time we are applying. This ratio is there in the list, but very frequently it will not be asked in every problem. Rarely it will be asked, but it's very simple. You have to remember. Next one, fixed assets ratio. It's an old ratio. It's an old ratio. Fixed assets ratio is one of the capital structure ratios. So what is the formula for fixed assets ratio? Fixed assets by capital employed. Fixed assets by capital employed. And what do you mean by capital employed? Equity share capital plus preference share capital plus reserves and surplus plus long-term debts. Long-term debts means debentures minus fictitious assets. So simply shareholders fund plus long-term debt is equal to capital employed. So here capital employed is equity share capital plus preference share capital plus reserves and surplus plus debentures. So equity share capital 2 lakh, preference share capital 1,20,000, then reserves and surplus 60,000 and debentures are 1 lakh. So take the total 4,80,000. So 4,80,000 is the capital employed. And how much are the fixed assets? 4 lakh. It is given in the problem. Fixed assets are 4 lakh. So 4 lakh rupees fixed asset and capital employed 4,80,000. So 0.83. This is the fixed assets ratio. Next ratio is debt service coverage ratio. It is the ratio which is given in the list, but so far in the previous problems we have not come across. First time we are applying the formula for debt service coverage ratio. The formula is PBIT divided by interest plus periodic loan installment divided by 1 minus tax rate. So PBIT, how to find out PBIT? PAT plus tax plus interest. PAT plus tax plus interest. Already we know it. Previous problem we have applied this PBIT formula. So PAT is 50,000. 50,000 PAT. And tax is also 50,000 because tax rate is 50%. Whatever profit you have earned, 50% you have paid the tax and remaining 50% is profit after tax. So when profit after tax is 50,000, that means tax is also paid 50,000. Tax is also paid 50,000. So 50,000 plus 50,000 plus interest charges are 12,000. How we got 12,000? Debentures. 12% debentures of rupees 1 lakh. To calculate 12% of 1 lakh rupees, 12,000 is the interest charges. So 1 lakh 12,000 is the PBIT. Now interest charges are 12,000. Now substitute PBIT 1 lakh 12,000, interest charges 12,000 plus periodic loan installment, that is given in the additional information in the problem. Last sentence it is given that debentures are redeemable in 5 annual equal installments, each of rupees 20,000. So every year periodic installment paid is 20,000. So 20,000 divided by 1 minus tax rate. The tax rate is 50%. 50% means 0.5. So 1 minus 0.5 is 0.5. So 1 lakh 12,000 divided by 12,000, 20,000 divided by 0.5. 20,000 divided by 0.5, you get 40,000. Now 1 lakh 12,000 divided by 12 plus 40, 52,000. So 2.15 is the debt service coverage ratio. That's it. Next one, absolute liquid ratio. This is an old formula. Already in the previous problem also we have applied. Absolute liquid ratio is equal to absolute liquid assets divided by current liabilities. Now, what do you mean by absolute liquid assets? 3 assets you have to remember. Cash in hand, cash at bank, and short-term investments or marketable securities. The investments which can easily be converted into cash within no time, with no risk, those are called marketable securities or short-term investments. So simply short-term investments plus cash and cash equivalent. Short-term investments plus cash and cash equivalent, that is called absolute liquid assets. So here cash in hand plus cash at bank plus short-term investment. So 10,000 rupees are short-term investment, 25,000 rupees is cash and cash equivalent. Total 35,000. So we got absolute liquid assets 35,000. And current liabilities are given in the problem 1 lakh 5,000 given in the balance sheet. So 35,000 divided by 1 lakh 5,000, 0.33 is to 1. Because it's a liquidity ratio. That's why 0.33 is to 1. The last and final ratio is basic defensive interval ratio. The formula for basic defensive interval ratio is quick assets divided by projected daily cash requirement. Quick asset divided by projected daily cash requirement. And a daily how much cash is required. First of all, quick assets. The quick assets are all current assets except one, that is inventory. Don't take inventory. The remaining assets are the quick assets. So what are the remaining assets? Short-term investments are there, receivables are there, cash and cash equivalent is there. So don't take inventory. So 10,000 short-term investment, receivables are 50,000, cash and cash equivalent 25,000. 85,000 rupees are the quick assets. Now, basic defensive interval ratio is quick assets 85,000 divided by projected daily cash requirement. How much cash requirement is the daily basis? It is given in the last paragraph of the problem. In the problem it is given every day 5,000 rupees is the daily cash requirement. Daily 5,000. And how much are the quick assets we are having? 85,000. So 85,000 divided by 5,000, 17 days. That means the basic defensive interval is 17 days. That's all. So this is the end of problem number 15. So far I have completed 15 problems. Each and every point I have explained in detail by applying full effort, whatever knowledge I am having. So if you are satisfied with my lecture, if you think that these lectures are increasing your knowledge, you are benefiting from this lecture, if it is the case, give a like to the video. That will give me more encouragement. And apart from that, give the comments, subscribe, share my channel in your group, in your friend circle, so that both students can watch the videos. Subscribe my channel. It's very pity because, well, the viewers are many, but the subscribers are few. Almost 50% of my viewers have not yet subscribed. I don't know why. Please subscribe my channel. It will give you more encouragement so that I can be able to provide more and more knowledgeable videos for your benefit. So the next problem, I'll do it in the next video.